Are you ready after your marathon?
All good.
Nice. Um, yeah, for those of you that couldn't join, Simon just jumped off literally like 2 minutes ago on a Twitter Spaces with our lunch, which was super interesting actually.
Don't sound too surprised. That was a joke.
I think I saw Farz in there. I can see as well. Nice. I imagine it was recorded, right? So we'll be able to share that as well.
Yeah, they recorded it. I think the guy hosting might have lost signal right at the end.
I see. Right. You guys ready? Do you want to kick off?
All good.
Cool. So yeah, thank you everybody for joining to our regular town hall happening every first Thursday of each month. And today is a very special day. Isn't that the case?
Yeah, it's crazy actually. I only really realized this morning. It's a year ago today. Voltz protocol launched. It's crazy. 12 months.
Yeah, it's quite crazy, and I think the space changed a lot since. Um, was it around that time last year?
Well, 12 months ago, um, just over 12 months ago, Luna crashed.
Yeah,
Yeah,
exactly.
just think about how much the whole space has changed since then. It's crazy.
Indeed.
Yeah,
Um,
anniversary
so
exactly.
hopefully the conversation is not about Luna today, but we do have a lot of interesting stuff to talk about, and we also have Alex on the stage that will walk us through how Voltz brought software rates to on-chain, which is one of the exciting things we deployed this month. Um, but we also have Arthur, Johan, and Simon on stage today. And yeah, so Simon, do you want to take it off comparing where we were previous month, where we are now?
Yeah, maybe briefly. There's over the past month, there's been a lot of craziness in DeFi. We've had obviously all the meme coins um, trading, which happened, and obviously for a period that meant gas prices were just insane. But I guess from a Volt's perspective, there's been quite a lot of trading, particularly in recent weeks. And there's obviously been new markets have been launched, which we're going to be talking about. And then alongside that, there's the kind of steady ramp up towards Volt's V2 going live, which is why there's that kind of ongoing Voyage initiative, which I think we're going to talk about as well. So just
Mhm.
ton of stuff going on, which is I don't know. I'm excited. This next month is going to be a pretty exciting month for Volts.
There you go. As if the current ones weren't already pretty exciting. Um, but yeah, V2 is very, very close, or like getting closer as we speak. And some other stuff happened as well. So as we said, we have software rates on Avalanche now. Are we maybe we speak about software in a bit?
Up to you. Happy to do whatever order.
Yeah, I mean we have Alex joined today, and it is something that it is pretty exciting. So maybe Alex, you want to jump in, and maybe you, Arthur, as well, if you want to like explain what is software and like yeah, how we made it happen, basically.
Sure, maybe I can just talk briefly about software and then hand over to Alex to go deeper into the implementation and how we kind of managed to practically get it live. So maybe some background on the software market. It's the first non-DeFi native market that kind of Voltz protocol has launched, and one of the kind of major differences between this launch and the previous ones is that now we're actually getting the kind of the rates from an off-chain source, which is the Federal Reserve API, which is served by our Oracle partner called Redstone. I think that in terms of the practical differences, that's kind of one of them. But in terms of the actual way that this rate is derived, it's very, very different from what we have seen in DeFi. So far is the kind of the secured overnight financing rate, which is published every day by the Federal Reserve of New York, and it's effectively the U.S. version, I would say, of kind of Sonia, which is a measure that aggregates a range of transactions that have been done by kind of financial institutions that used USD denominated treasury securities as collateral to borrow overnight cash. These transactions tend to be aggregated and averaged to produce a rate which can then be kind of treated as a benchmark borrowing rate and referenced in the range of derivatives beyond just kind of vanilla interest rate swaps. And that's, I guess, some background on software. And one of the most interesting things about this market, at least for me personally, is that it's a lot more attached to the, I guess, what's happening in the real world, meaning that the research and analysis kind of published outside of the DeFi bubble is still applicable and can be used to kind of make trading decisions, both kind of from the speculative lens, but also when it comes to hedging volatility coming from various different decisions stemming from the Fed and just overall kind of market activity. So I guess, that's a kind of high-level overview. I guess it would be quite nice if kind of Alex talks through kind of how it was actually implemented.
Yeah, sure.
Yeah.
I can jump in, I guess, on the implementation details. So I guess, like, to start from the beginning, as Arthur mentioned, I guess the software rates are computed and published by the New York Federal Reserve every business day. And once that those are published, the rates are immediately picked up by, I guess, Redstone, which is the Oracle partner. And they will publish the values on chain, and then this will allow, I guess, the smart contract, the Voltz smart contracts to read the most up-to-date rates. And now, I guess, when talking about the actual implementation in the Voltz smart contracts, the software pools follow the same structure as the other pools, to be honest. And this means that there was a custom rate oracle that was built for software, but everything else stayed the same. And I guess this shows that the protocol is generalizable and is able to handle, in this case, TradFi markets pretty straightforward as well. But of course, there were a few differences when building this custom rate oracle in the Voltz smart contracts, especially in the way the New York Federal Reserve computes APYs. So, for example, rates are not compounded continuously over time, as in the case of Aave, for example, but rather like every business day. Another example would be that they use like a 360-day year when computing APYs rather than a 365-day year. So there were a few differences, but overall, these differences were small, and I guess this just shows how general is the protocol. And I think, to be honest, that would be it in terms of the implementation details.
Nice, sounds pretty simple. And maybe just to top on this as well, maybe you, Arthur, Simon, want to kind of like double down on why is this a big deal?
Arthur, do you want to go first?
Yeah, sure. I mean, I think I kind of alluded to it, that I think it's a huge deal when we start thinking about just the underlying TVL of the software markets and the volumes that we see in the TradFi world. It's in the range of quadrillions, which is a huge number that's hasn't is very kind of dwarfs everything we have seen so far in DeFi. And we kind of see it as a bridge that enables us to take a market that's already well established outside of DeFi and use it as a stepping stone that would prove the power of the technology in kind of serving a need and serving a market that already exists in a way that's different from how it's been done traditionally. I see it as a very exciting experiment and just one of the many steps towards unlocking the potential of the technology we are building. I think it's pretty it's very exciting to have been able to experiment with kind of Aave and kind of Lido, Rocket, and other markets. One of the main limitations of these markets is the fact that the TVL limits the ability of the markets to of the derivative markets on top of this underlyings to grow continuously. Because of the kind of risk of Oracle manipulation attacks, it's much easier to manipulate rates that are based on a TVL that in the millions and even single figure billions. But when we look at the repo markets that the software rates are kind of derived from, they're a lot less manipulatable and they have a lot more room for growth and validation of the technology. And I think that's kind of one of the probably many things that I personally find very exciting about this market.
Yeah, I think to add to that, I kind of view it broadly in two kind of like buckets. I think on one side, this is a market that everybody's exposed to, but has previously only been accessible to a small handful of kind of institutions in traditional finance. And to open up that market in a permissionless way, such that anybody in the world can hedge, or anybody where kind of Voltz protocol is accessible, it enables them to either hedge exposure that they might have, or to, if you want to speculate on the kind of decisions that may be made in the future and the directions in which those rates might move. So to open up what is, like, frankly, kind of the biggest, I think, if not the biggest, one of the biggest markets in the whole of the world, to everybody, that is obviously an exciting step on its own. I think the kind of like second big bucket, which is kind of what Arta was talking to as well, is, the long-term kind of objective really has got to be to kind of move the entire global financial market onto blockchain rails for a whole bunch of reasons, not least of all the capital efficiency that would unlock for the entire world. And in order to do that, we obviously have to take like kind of these kind of smaller baby steps, which actually, as steps in their own, arguably are not that kind of baby. They're actually pretty big steps. And this is, in my mind, a kind of one of those kind of steps that we need to take as an ecosystem, where we're really bringing down like the barriers between DeFi and TradFi, and actually opening up a market that previously existed in traditional finance, but replicating that on blockchain-based rails, such that people can come in and start trading that same market, but on new infrastructure. And obviously, over time, as we do that kind of more and more, that ultimately enables us to get to this much kind of bigger, kind of long-term objective of having all global markets exist on blockchain-based rails.
Well, thank you for that. And could we maybe flip it a little bit? Usually we do like Q&A at the end, but since we're talking about software, we had interesting question about not generic, but more like one of our pools and related to the margin. The discussion went on yesterday already, but maybe it would be good to touch on what are the margin requirements on that pool specifically, and why is that set that way, and if we're going to do anything about it, since I have Alex on the stage as well. And maybe you, Arthur, or Simon also want to chip in.
Yeah, Alex, do you want to talk to kind of the way in which the risk parameters are calculated in the first instance, and then I can kind of talk to what we're going to do?
Yeah, sure, of course. Yeah, so I guess when configuring a given pool, there's this like risk engine which will compute all of these different risk parameters that will feed into the pool. So these parameters are used to compute margin requirements, for example, when a new trade will happen, and also like throughout the I guess position until maturity. And I guess in the case of the software pool which expires in December, so that's a longer pool. So I think it's like 7, 8, or like 7 months, right? So the risk engine requires like past data of at least the length of the pool, right? So if we look like 8 months ago, the software rates were as low as 2%. And I guess this influenced the risk engine to come up with some more conservative risk parameters. And I guess this is also why the community raised this yesterday, the fact that the margin requirements are maybe a bit too high for that pool, given the situation and the current software rates.
Yeah, and just maybe to build on that, there's I guess there's the way in which kind of the risk engine has worked for markets that existed on Voltz protocol so far, and that's worked really well. So that's kind of like the methodology that has been used and applied, as Alex just talked through, to this SOFR market. I think it's a pretty kind of legitimate kind of challenge that just given rates have moved so much, or the SOFR rate has moved so much over the past kind of several months, that has contributed to kind of higher margin requirements by using that kind of same methodology. And it's certainly something which we're looking at, whether or not that methodology is actually representative of the type of exposure and risk that could exist in the system through the kind of terms of these pools. I think it's pretty reasonable to say that it's probably overcautious. So we're just going to spend some time looking at it kind of through the rest of this week and early next week to try and make that a little bit more representative of the risk, which should in turn increase the leverage available for traders.
Nice, cool. Hopefully this is we answered your question, but yeah, feel free to follow up. It's definitely something, like, as we always say, we like to hear from you all, and this is very helpful. Thank you, Alex and Simon, as well, for jumping in. Should we change topics a little bit and talk about something that actually happened yesterday, which is rollover?
Yeah. So you're trying to remind me. Rollover happened yesterday. This is not necessarily helpful, but it's just been such a busy week. There's like an announcement that we will make sure we do in the future is just always announcing exactly what has changed at the point that new pools are launched or pools are potentially expired. And yesterday was quite a big rollover because pretty much every pool on the protocol matured except for the SOFR pools. And kind of if you to go to the markets now, what you'll see is there's kind of like a reduction of the markets that exist solely on Ethereum, just given kind of gas prices that can be pretty high at times. And instead we've tried to boost the markets that exist on Arbitrum instead. And then alongside that, there are just a couple of things that did change. So both the DAI and USDT pools were kind of essentially retired just for the time being. just given there's been quite a lot of trading on the USDC markets. Actually, the decision that was made was to kind of launch more of those markets instead. Clearly, like the markets exist for people that use the protocols. If there is kind of a lot of feedback that people want, for example, the USDT market to come back, that can be enabled pretty easily. The other thing that happened is GLP markets. If you think about the fees that LPs kind of collect, that should be representative of the risk, which kind of the other way of saying that is if the pool is extremely volatile, then arguably the fees should be higher. It's one of the things that probably got overlooked at the point that GLP was first launched. But now looking back on the data, you can really see that LPs, whilst there are LPs that have been generating money, it is kind of reasonable for that fee to be higher. So that got increased from 10 bips to 50 bips. All other pools except SOFR are 10 bips, with SOFR being 2 bips for the LP fees. And then the final thing that happened, so there were the RETH and STETH pools that existed. There has been some trading on that recently. One of the things that we're actually pretty excited about and keen to get kind of community feedback on this is there are some new rates that are being created where they aggregate kind of the returns across every validator that exists on Ethereum, rather than just a subset of validators which kind of exist with Lido or with Rocket. So what we've been looking at, and again, keen to get feedback from the community on this, is instead of launching a Lido and Rocket pool, actually launching like a whole of market pool, which can become a really interesting rate for people to either arbitrage relative to Lido and Rocket, or actually start to use as a kind of reference rate, because it's kind of representative of like your risk-free rate that exists in Ethereum. So they're the main changes. There's, just to kind of recap, more pools on Arbitrum, kind of increase in GLP fee, and then RETH and STETH pools have been like retired, just whilst we kind of continue to explore this whole of market staked ETH kind of rate.
Well, thank you about that. I just wrote a quick summary as well. But yeah, you probably noticed those changes. That also means that if you had positions on those retired pools, you won't be able to roll them over. You can only settle your positions at this point. Same will happen with your optimizers if you had any on those. But yeah, feel free to spend more time on Arbitrum if that's what you wish. Definitely gas cost is way cheaper now that you guys trading meme coins. Cool. We've got like 2 more topics to talk about and not so much time left. So maybe we go into Voyage and then Voltz V2. Is that right?
Sounds good.
Cool. So Voyage, we have passed halfway or midway point for week 3. If you have been completing the previous tasks for the previous 2 weeks, you will be able to see that on the Voyage page, which is just a special tab that you have on the app. As in general, we don't really disclose how to get those badges. They are SBT based, but I don't want to say too much, but there will be some interesting stuff happening at the end of the Voyage. Might or might not be related to SBTs. That's all what I'm going to say for now.
I can't react. How do I react?
Just,
I can only do it in the
chat. Yeah, exactly. But yeah, there's a bunch of stuff that we've prepared for the end of the Voyage, and I do see like some Coty asking like some hints on Voltz Voyage. Feel free to ask that in general channel, and I bet there will be some people in the community that are willing to help you.
I'm surprised no one's worked. I'm surprised no one's worked it out yet, though. But
I'm sure they did, but a bit of PvP maybe. Cool. So that's Voyage, but obviously Voyage is leading to something that might or might not be Voltz V2. Voltz V2 is like getting closer and closer. Maybe Simon, you wanna give a quick update?
Yeah, I mean, well, so maybe just macro level. Obviously, Voyage exists to like we kind of put out in the blog post around this to give early access to Voltz V2, where that is like a massive expansion of the capabilities of Voltz protocol, which I can talk to the extent that's helpful. Maybe just briefly, or less, it doesn't even need to be briefly. Arta, I don't know if you want to talk to kind of like where we are at on the roadmap in terms of building out V2.
Yeah, sure. So from kind of V2 perspective, there's been a lot of work recently, and kind of in very very soon we're gonna be pushing it out. But that just to zoom back, I kind of wanted to maybe walk through the high level architecture and like how is V2 going to look like in its end form, and where we are at in terms of the roadmap towards getting towards that end form. So the core idea, I guess, behind V2 is that it is a low-level primitive that effectively acts as a clearinghouse that enables the creation of margin accounts, where these margin accounts can effectively work across a range of different collateral assets and across a range of different taker and maker positions initiated on top of the instruments that are kind of registered and supported by the clearinghouse. And that means that once there is the core, the clearinghouse, then as soon as you have instruments on top of that, you can then spin up exchanges, which could be in the form of an AMM, like we have had with Voltz V1, or it could be any other form of market making primitive, which could be CLOB or a passive liquidity provisioning scheme. And the end game of V2, I guess, based on our current view, is that we have this pieces all aligned and ready to be used and to be integrated with by the kind of the teams that want to develop new derivative exchanges, pricing mechanics, as well as other market makers. So in terms of where we are at in the journey towards that end game is we have deliberately split the execution of V2 into phases in order to make sure that we ship it in a secure, robust, and kind of gradual iterative way with kind of community feedback and in between releases. And the initial release, which we call the MVP version of V2, is the one that we're kind of getting towards the end of the shipping process. Is going to be a trimmed down version of the full V2. It will have support for the integration of instruments. However, in the beginning, it will only support a dated interest rate swap instrument, which has the same payoff mechanic and mechanism kind of as the interest rate swaps on V1, with the only exception that this new instrument is now fully integrated with the V2 rails. And as the first exchange on the protocol, we'll be using a kind of virtual automated market maker that has been adapted with some small changes to also work with the clearinghouse there. That is the kind of the current state and where we are at the moment. But over time, over the coming month, there will be further iterations which will introduce cross margining, quite a big chunk of changes to liquidation mechanics, as well as kind of the introduction of the kind of generalizable instrument and exchange layers that are then going to be available for other teams to integrate. And yeah, I think that's at a high level what the roadmap, I guess, looks like, where we're at, and where we want to go.
Nice. Anything to add, Simon, or you got to?
Well, I think the only thing that I'd add is obviously, well, so the kind of low-level Rails create the opportunity for other teams to come in and build on top of essentially a generalizable margin engine that will exist in DeFi for the first time. And for kind of makers and takers that might interact kind of through that primitive, there's a ton of benefits, kind of all which ultimately result in kind of increases in capital efficiency. And then maybe just to explain that kind of really briefly. So the way that DeFi works today is that we've essentially had proliferation of trading venues, which on one hand is great because there's been a ton of innovation. On the other hand, it's kind of a negative because it's created kind of like this fragmented market where as makers and takers, you have to post margin. If you're trading across multiple venues, you have to post margin to multiple different exchanges, despite the fact that those positions on those different exchanges might be offsetting. And what the V2 Rails enables is it enables this kind of at an abstract level, like a low-level operating system, like a financial operating system to exist on any EVM chain, which all of a sudden enables these different exchanges to be able to essentially talk to each other. And at a practical level, what that means is it means instead of having one margin account per exchange, you actually just have to have a single margin account that is able to interact with each exchange. So if anybody's listening to this as a kind of new kind of DEX team or an existing DEX team and is keen to explore kind of how you could build on top of these kind of low-level Rails that we're creating, then obviously please do reach out and yeah, we'd be keen to talk.
Yeah, exactly. Yeah, you can open a ticket if you want to bring more privacy in, and you have access to the team. Cool. And in terms of what we're working on, V2, it's not the only thing. So you probably have noticed how every now and then we keep updating the UI with new functionalities or small changes in functionality and UX improvements and quality of life improvements, etc. There's a new screen coming very, very soon. I might be sharing some of that in a small subset that we have, which is for it's what we call the testers. If you want to be part of that group and you're an active Voltz member, just reach out and we can talk about it. So yeah, if you're in the testers group, soon you will see what is happening and what will be coming live very, very shortly after. Right, so let's move into QA. We have a couple of interesting questions left that I want to go through. So one is regarding LPs and the suffers that the losses that they sometimes suffer due to trading support. So have we considered adding incentives to improve the situation, such as giving liquidity providers another reward in addition to fees? For example, rewarding them over time if the current rate is the winning a set range, is within a set range. So yeah, who wants to take this one, Simon?
Yeah, it's kind of really interesting question. There's I guess there's two parts to it. There's the first part, which is LPs and how to generate profit as an LP, and then there's the second part, which is I guess around incentives for liquidity providers. On the first part, honestly, there's you know, we obviously do kind of like quite a lot of analysis on the data. There's times, particularly recently, where we've seen LPs generate what in excess of 60% API, like APY, on markets where there's been kind of where they have deployed liquidity in a way that is both concentrated, so kind of choosing the right tick ranges, but also with sufficient leverage, which again contributes to their returns. And when obviously the final thing is that there's kind of like quite a lot of trading volume in those markets. The kind of other side of that is also true. If someone chooses the wrong tick range, then they risk exposing themselves to kind of losses. So I guess when you kind of think about that question, the first part is it kind of implies that everybody's not making money, which is 100% not the case. And what we kind of care about, kind of really helping LPs with is helping them like understand how to make those decisions on what tick ranges they should be deploying liquidity within in order to generate profits rather than get locked into the wrong side of a swap and generate losses. That's the predominant thing that we're focused on. From an incentive perspective, obviously Voltz, like there is no Voltz token. Just be careful of that. There's even when we had this SOFR announcement, there's a kind of like a news outlet that basically tagged a fake Voltz token. So do be careful with that. There is no Voltz token. So therefore, incentives from that perspective can't exist. There are, of course, kind of badges that can be earned off providing liquidity in the right way. But yeah, it's kind of without the token, there's obviously kind of no way to incentivize that side right now.
Yeah, exactly. And thanks for reminding everybody that there's no token yet. I see a couple of questions regarding tokens. It is not our main focus. I would say V2, it's probably our main focus among other things. There will be a token in the future. Well, we'll see. So, cool. One other question that we've got. This just came in very fresh. Circle is natively launching USDC on Arbitrum on Jan the 8th. How does Voltz handle this? I don't know if anybody had time to check this one out.
When did that get announced?
Today. I think it was just like a few minutes before the town hall.
Arthur, have you seen it yet?
Yeah. It's I think I first heard it from the community actually, yeah, I think it's not. I think it's expected that I think originally USDC launched on Ethereum mainnet, and then there's been a proliferation of alternative infrastructure layers, L2s and L1s, including Avalanche, that in the early days were just bridging to kind of the platform of choice from Ethereum. And that's kind of what has been historically done on Arbitrum as well. So all the USDC that people are using on Arbitrum is just a bridged version of USDC from Ethereum mainnet. But according to kind of the recent news, kind of it seems like it seems like Circle is expanding on their strategy to bring USDC onto native USDC onto infrastructure layers beyond just mainnet and Avalanche, but now also to Arbitrum. Which means that I think, in general, I'm quite happy with things like this. That given the risk of kind of bridge attacks and all the problems we have seen coming from those, and I'm quite excited to see how this token would be adopted, and I expect it would eventually start to displace the bridged version of USDC on Arbitrum. At which point, my feeling is that the ecosystem will start switching towards that. And from our perspective, it's not nothing very difficult. If the community feels like they want to switch over to the native USDC, it will be quite easy to do with the rollover of kind of new pools when the adoption starts to kick in.
How is it going to be called? Because I think the bridged one is already USDC.
I think on Avalanche there's like USDC.E and there's native USDC. Maybe on Arbitrum there's going to be the distinction like USDC-E, which is like the Ethereum version, and then just native USDC. But that's very nice, I think.
There we go.
Bridges.
Nice. Thank you very much for that and quick response time. Any last minute questions? Otherwise, I will just thank everybody that joined the stage and all the questions that the audience asked. As usual, very useful. And I've noticed Lopini is on the audience, which means I'm expecting a full summary of the call and a transcript please send that to me and I'll share it with the community. It's very useful if somebody wants to just read what we just said. There we go. Cool. Thank you very much, everybody, for joining today. Thank you, Alex. Thank you, Anna, Arthur, and Simon, and everybody else from the audience.
Cool. Thanks, everyone.
Thank you, everyone.
Bye-bye.
Cheers. Bye.